Are you looking for a vehicle for financial freedom? Do you want to retire early or possibly be able to have a safe retirement? Well, I believe in real estate, the Live Then Rent plan is the right way to go. And today I'm going to show you what that looks like in a scenario, and you're going to learn why this is beneficial versus traditional investments. My name is Ariel Herrera, your fellow data scientist with the Analytics Ariel channel, where we bridge the gap between real estate and technology. I love making these videos and I want them to be able to expand to other people to also watch, so please like this video, and if you like the content and want to see more of it, also subscribe. Great, so first off right here, what you see is a Google Excel sheet, which you can actually download later on your own. It's in the show notes. And in this first part of this series, I'm going to go over a walkthrough of why this Live Then Rent strategy is great for investing. In a later video, I'll also be covering a calculator so that you can actually get a little bit geeky and understand how you can implement this by the numbers. So first, let's go over the scenario. We have two people, Jonas and Wendy, they're a fun couple, who are looking to build wealth for financial independence. This means they're not relying on a 9-to-5 job in order to keep them going. So they want to have a predictable and passive source of income for when they retire. Their goals are to retire early, hopefully before the age of 65, and live off of a combined $72K a year in a low-cost area. Some of you may say who live in the East Coast or the West Coast, $72K a year for two people is not enough. However, if you live in a low-cost area, it definitely can be. Let's go to the next part where Jonas and Wendy are actually going to do research for passive income ideas. And what is so amazing about passive income is that you can actually make money while you sleep, meaning that the work that you put in the beginning, all that effort, is able to actually generate you income in the long run. So for example, a lot of people do side hustles with Uber, but one of the negative parts is that if you're not actually driving or doing the Uber rides, you're not making money. Whereas in these strategies, you make money without physically at that time putting in work. So Jonas and Wendy come across three strategies. This is stocks, arbitrage, and real estate. So for stocks, they realize that they can have a high return on their investment due to compounding interest. However, inflation protection is medium. Reason being because there could be downturns as well as upturns in the market, and sometimes that could be a bit unpredictable. Lastly, control of their investment, I would say, is pretty low. Reason is, if you invest, say, in Disney, you have no real voice as to how the CEO is making strategy decisions, what kind of income is going to be coming into the company, and what expenses they're doing as well. So in this case, your investments are passive, however, you don't have as much control over them. Next is arbitrage. That's basically when you buy low and sell high. So a lot of people have a strategy with, say, Amazon arbitrage, where you buy large bulk products, like say toothbrushes from a warehouse or factory in China, then resell them on Amazon, make sure that you get high reviews, and make a margin of profit. Now, you can get, I would say, a medium return on investment because you are usually selling low-cost items. Say the toothbrush costs you $1.50 per toothbrush, you're reselling it for $2, you're going to make 50 cents, which isn't really that much. However, over a large scale, it could be. Inflation protection, I would say, is low because in this case, say if the warehouse, those costs went up, not necessarily would people want to purchase your product for more money. So that can actually hurt you. And lastly, control. One of the best parts about arbitrage is that you actually have pretty high control of what products you're selling, what the price is, and then also some of the supply chain behind it. Now lastly, my favorite vehicle, and you'll see it's also Jonas and Wendy's, is real estate. Real estate is great because you can get a high return on investment, and what also helps is appreciation, even though you should not bank on it. Second is inflation protection. So usually if you're in a good market that's consistent, as wages are going up and also different goods and services are also going up, usually rents also go up as well. So it's consistent with increases. This is really important, especially for people who have pensions, for example, where say they're making $50,000 a year in their retirement. Well, that could be great in the first several years, but later that can actually be detrimental because now, when they're 85 years old, that $50,000 doesn't take them as far. So it's really important to be able to hedge against inflation. And lastly, real estate, I put medium for control, but it really can go, I would say, even to the higher end. Reason being is you can get involved as you want into real estate, into the property you're selecting, the rehab you're doing, the tenants you're putting in place, the location of it. There's so much control that you have. However, there is always that risk that a tenant may not pay on time. Even if you do all your homework, you can eliminate that risk down to maybe a 5% chance. However, it's still there, which is why I put medium for control. Now, Jonas and Wendy have analyzed that these strategies want to follow up with real estate. And to recap, they want to do it because it has a high ROI, has asset appreciation over time. That means that the income or the money that they put in initially can grow over time. Second, rents protect against inflation. And lastly, they can actually increase the value of their asset using rehab projects, marketing strategies, and more. Jonas and Wendy have picked their investment vehicle, but now they need to determine how are they going to get there? How are they going to accomplish this? Well, as we said earlier, they need $72K in passive income a year for financial freedom, where they wouldn't necessarily have to work again if they didn't want to. They could pay for all their expenses. So, the second requirement is that they want to own their properties free and clear when they achieve financial freedom, meaning that they don't owe a loan to a mortgage or they don't owe a loan to a bank. So we see here that they require $72,000 a year, which a month would mean $6,000, just divide by 12. So how do we get here? Well, if they can invest in 3 properties that generate cash flow that's around $2,000 each, 3 times 2, they would be able to actually hit their requirement of $6,000 a month if they had these properties free and clear from any debt. And that is the strategy that they're going to take. 3 properties using real estate. Alright, so now it's time for Jonas and Wendy to be able to actually use strategies to implement what they want to do to accomplish their goal with real estate. So they look into 2 different strategies. The first being the traditional route. So the first is buying investment properties with 25% down. And traditionally, if you're not living in the property, you're going to buy a property solely to rent it out. It's 25% down required by banks and lenders. Now that could be a little bit hefty. So there's a second strategy that they look at, which I call the road less traveled, also known as live then rent. So this is where they could buy properties as the owner occupant, so the person living in it, then rent it out after 1 to 2 years for a lower down payment. Alright, so let's go through the 2 different strategies. So first, traditional strategy, let's say that we have our 3 homes. Each one, to keep it simple, is going to cost $225,000. Now we know that these can go for $2,000 a month for rent. And once our loan is paid off, we're debt free, we would have those $2,000 directly in our pockets, and this will allow us to achieve financial freedom. There are a lot of different numbers to account for. I'm making this very, very simple. In the rent calculator, there's a lot more detail there. But to keep things simple, let's look at the next step, which is how much percentage down in traditional route, which is 25%. And what this means is based on the home price, both Jonas and Wendy would need to put down about $56,000 per property in order to own them as investments. In total, this would be $168,750. Now let's look over to the live then rent strategy. So lenders allow you to put less percentage down when you're living in the property because you have more stake in it, and it's less likely that you would default in certain cases. So here, instead of putting 25% down, you can get a commercial loan for 5% down. And in this case, the down payment for the same properties would be a lot less. It's $11,250. So when you add those up, it's $33,750. So when we compare those two, you can see there's a clear winner for the investment strategy. Jonas and Wendy no doubt want to select the Live Then Rent strategy. By choosing this strategy, it means that they can actually put down 5 times less the amount. So they save $135,000 just by avoiding the traditional route, living in these properties, and getting out of them within 1 to 2 years. So I hope you enjoyed this video. I'm going to be going over more metrics in a later section, and please subscribe so that we can bring more content like this to you. Thanks.